any investment, there are always associated risks. Risks can be anything from general market conditions to the precise location of the property and a myriad of factors in between. One of the first items to look at with market risk is pricing. Acquisition price plays a significant role in determining the expected appreciation for the project given where current prices are. If the sponsor paid above market value, it may limit the upside for the project on the back end, especially if it is sold in a down market. As investors, you may have seen or experienced the limited product available over the last year or so. Pricing has played a key role in limited supply because it's hard to get the numbers to work when prices are as inflated as they are. This is also the reason you'll see many sponsors releasing product in similar locations. The second is going to be whether the project provides a hedge against inflation or not. In general, this is going to be a risk to net lease projects with rental escalations that lag behind the pace of inflation. One hedge against this is targeting projects with rent bumps that are tied to the consumer price index or using net lease as part of a greater portfolio construction. And lastly are the debt market conditions and the effect it has on supply, projected distributions, and at exit. As we've experienced recently with rapid fluctuations in the debt market, digging into the terms of debt on leverage offerings is one of our top priorities. If interest rates continue to rise, which increases the cost of debt, buyers will likely want to pay a lower price for the asset since the cost of debt has risen. Looking at geographical risk, we really drill into two main areas: market versus market, which in this context means comparing one metropolitan area to another, and submarket versus submarket, which refers to the different neighborhoods of a metropolitan area. As I mentioned earlier, market risk can be looked at regionally or nationally and applies to general market conditions, but typically our assessment starts at the metro level. Since the metro area can define the demand drivers and employment drivers for an area, this is ultimately what drives the long-term prospects for a project. For example, we have seen a large population growth and income growth in Charlotte, North Carolina, and this bodes well for apartment deals. Next is going to be submarket risk, or risk that is neighborhood specific. This is where we really dive deep in our analysis. This is where we look at supply and demand dynamics, or how many units we expect to be delivered, and what percentage of those units we expect to be occupied or absorbed, as well as demographic trends such as median household income. For the most part, our outlook on a market is based on more of a soft analysis, whereas we take a more granular approach when looking at a submarket and really dive into the numbers. At this level of analysis, one block can make the difference in terms of deal economics.
The two main types of properties that we review are multifamily and triple net. Multifamily properties are your typical apartment complexes ranging from high-rise to garden style. Triple net offerings refer to commercial properties, usually retail, office, or industrial, where the tenant pays the taxes, insurance, and maintenance of the building. If the offering is absolute triple net, the tenant will also pay the roof and structural repairs. When we're examining the multifamily properties, we like to look at certain factors like average household income at the property and what industries the tenants are working in. With triple net commercial properties, these factors don't matter as much since the lease payments are set in stone. A triple net lease payment is all but guaranteed, and sometimes it actually is guaranteed. For this reason, we focus more on the financials of the tenant, reviewing their balance sheet and income statement. Other property types that we come across are hospitality, student housing, senior living, and self-storage.